There you are. Hello, Mr. Coffman.
Good morning.
How's life treating you today?
Oh, yeah, it's a gloomy day out today, but we're going to try and make the best of it. We got an exciting event happening today. We're getting rid of we finally disposed our new build out there, so that closes.
Yep. Yep. Yes, I am excited about that myself. In fact, I might have a cocktail or two, or if that all gets signed and sealed as we are scheduled to do so at 2 p.m. this afternoon. Can I just say as another note? So my eyes seem to actually get worse on a daily basis now. And so I used to think that people would take their glasses off and like clean them to make people, just to look smarter and have something to do with your hands. But no, the glasses pretty much get dirty constantly. So I'm constantly have to clean them because they drive me crazy. So
Yeah, I
sorry.
think I'm on my way to.
Yeah, it's the small things that amuse me. Apparently. So
I'm definitely on my way to. I hate to admit this, but I've always had really good vision. But I don't know. I think it probably has a lot to do with the amount of business I do on the phone. Looking at the phone has become a real chore.
oh,
It's hard
yes.
to do I hear 50 is the age. So like from 50 on, it says you got to really take care of your eyes.
I think that's true. I just turned 52, so I'd say in the last 2 years, that's probably a true statement. Like it's definitely worse. My eyes are definitely worse than the last couple years.
Yeah.
And they say like eat these vegetables to help, like eat all this food stuff to help you do all this different. Like I'm eating all of it. It's not like it's not helping my eyesight. So I don't know
Red
what.
light therapy, man. Red light therapy. I have seen people really benefit from red light, exposing their eyes to red light. In fact, totally unrelated to real estate, but um, kind of learned through. I don't know. I really don't know the channel that I learned this through, but there used to be such a thing as sun gazing.
Oh yeah.
In fact, there are in hieroglyphs in Egypt where they depict people that would wake up, in the morning. They would get the morning sun, the and they would stare directly at the sun for a period of time. So there's that too. I'm pretty foo when it comes to that stuff. I try all that stuff. I experiment with a lot.
You are. That's right.
I'm
And of
usually
course,
like,
well, of course, gazing at the sun, you got to do it like when it rises or when it sets, so
right,
that it's at the angle where it won't hurt your eyes, and not at
right.
noon. Just like we'll clarify that for anybody that may watch
Yeah.
that
Full
later.
disclosure, I am not advocating going out and staring at the sun. I'm not doing
At
that.
noon when it's at its most
Yeah,
intense, and that's
yeah.
yeah. So it's good
But
stuff.
other than that, man, it's gonna be a good day. I too will probably I will probably celebrate a little bit today. And I've got I brew beer, so I've got a case and a half of a saison here that's sitting here, and tomorrow will be the official day I can officially crack it open. So that's probably what I'll do. So
That's good stuff. And
yes,
I
sir.
don't know why your same business colleague here has not had any of your brewed beer, your home brewed beer, but that sounds like that needs to be rectified.
There
But
there are
sure.
rules around my beer. There are rules that you have to follow, and one of those includes you cannot drink out of a bottle. If you drink out of a bottle, you are banned from
Gotta let
drinking.
it breathe. Yep. Gotta
Yeah,
let it breathe.
and then you have to save the bottles because I do buy the bottles for the most part. I do have some that are donated, but regardless, if you'd like me to fill those bottles up for you again, I'm going to need them back. But that's really the joy behind beer brewing. It really is just giving it away and just getting people's opinions. It's just a fun little hobby.
Yeah, that's good
But
stuff.
but anyway,
So,
yeah, let's.
welcome back to the Creative Real Estate Investing Mastery podcast.
I love seeing you struggle with that every week. It's so great.
I have the blueprint right here on my wall, and I screw it up every damn week. It's an amazing thing. Like I have it right there for the most part. I just got to stick the word mastery in it, and I never put it in the right spot. So it's all good. But what's on the podcast agenda for today, Mr. Kaufman?
Okie doke. Well, we last week we covered what was the topic last week? I only remember one section of it right now.
We were talking about the financing, the changing of 50-year loans and the
That's right. That's right.
financing
That's right.
and the
Yeah.
Fed represent kind of what the financial forecast is for loans and
Right.
all of that.
Right. So essentially, the cost of money is what we were, um, what we talked about, and how to calculate your exact cost of money in a percentage form So, and then we use the loan constant to do that. And so, I'm not. I told you this before, but I this week I saw in a Facebook group somebody trying to determine whether or not they wanted to stick with the loan. They're getting ready to refinance a property. If they wanted to stick with a loan that was sitting at 7% or move to a DSCR loan, which was at 6.25, which I think over the long term, I mean, that's obviously it's not quite a point, obviously, but it's a better deal. Even with the fees that come with or that are inherent to a DSCR loan. Usually their fees are pretty crazy. Um, but the difference between those two is this guy had on the 7 year, he had it amortized at 20 years. On the DSCR, it was amortized at 30 years, which is very common for a DSCR product as well. So I responded to him and told him basically how to figure out what the actual cost of this money and how much savings he would actually see year over year based upon this loan constant that we talked about in last week's podcast. And so this week, I thought we would, if that didn't land with people last week and they didn't quite understand it, I thought we would break that down a little further. And I would try to actually, because I can get really into the weeds in this stuff, I would try to make it as simple as possible. It is very simple. It's just I don't have the ability to be simple.
Well, we'll help you say something. So really, this podcast though is like the next step off of last week's, and it's really like I'm just gonna put it this is really like a creative financing pro tip podcast episode,
Right.
right? That's really what it is because we're going to take two different numbers, right? The cap rate and loan constant, and we're going to compare them, right?
Right.
That's really the pro tip.
Right. I'm going to bring up my notes here. But yeah, essentially, a lot of people, I'm talking about cap rate. A lot of people think that cap rates are for apartment buildings and you don't use them on single family. Um, but I will tell you that I don't think if you really really want to know your numbers, you should probably figure out your cap rate on every property that you buy.
Yeah, even if it's single family.
Yes, including single
Yeah,
family.
yeah,
100%.
but you're right. The cap rate is primarily used for multifamily as a number, but it's a great number to use here for comparison purposes.
Yeah. I mean, they use it for multifamilies, obviously, because comps are rare. And so sometimes it's hard to really gauge the value of a property, of a multifamily property. And so, it's very common to use it in multifamily. And there isn't a single deal that you're going to find where you're not going to ask for what the cap rate is on that particular property. Um, but what I want to show you is why it's so important to know, and particularly how it relates to creative finance and how you can use it in creative finance. And I'm telling you, there just aren't many people that are doing this. And if you went through this one simple exercise, all of these comps, and you have dislike properties, you've got all of these different properties that you're trying to comp a property on. And so this can lead to this analysis paralysis thing. I'm going to show you a very, very simple way to to be able to determine. I can't speak today, whether or not you've got a good deal on your hands. It's surprisingly easy. It's
Yeah.
surprisingly easy.
But
So,
whether you have a good deal based on the financing that you're trying to obtain,
correct,
or which is the better financing.
correct.
So that's really this. So let's take it one at a time. So let's just go back. And I know we
I have to
mentioned
interrupt
some of
you
this.
for 1 second. I have to interrupt you for 1 second. It's not just the financing that you are trying to acquire, but we're also talking about subject to here.
Yep. Yep.
Because we're gonna try and every seller we attempt to make them our financier. So um, I want to break that down for you as well and show you why. I'm going to show you the benefits of actually buying these properties subject to, and I'm going to put it into a mathematical equation for you. So anyway, sorry for interrupting. I just
No.
there.
Totally fine.
Yep.
Let's just take it. Let's go one item at a time. So we're really going to just be comparing a couple things. So let's talk about cap rate. So let's define cap rate and then do a really quick, easy example, and then we'll move on to the loan constant. How's that?
Okay. All right. You want to define cap rate, or you want me to do it?
No, cap rate is just your net operating income divided by your purchase price. That's how we're going to use the cap rate for the single family home comparison. So just a quick example, your gross rent's $1,800 a month, right? You have $600 a month in expenses. So that means your net operating income is $1,200, right? Or $14,400 a year. You pay $240,000 for the property. These are really, really quick numbers. So 14,400 divided by 240,000, 6% cap rate. Okay.
Right.
So
let's talk about. I do want to break down what NOI actually is as well, so that we can, without getting into the weeds, because a lot of folks when they consider NOI or they're trying to calculate NOI, they don't actually they miss things. They tend to miss these expenses. So, and plus there's other quote expenses that do not apply to an NOI. So I just want to go through
absolutely
kind of what what expenses you're looking at that come into play when you're trying to calculate NOI. Number one is property taxes. Number two, any property management fees. And we've got insurance. We've got any kind of an HOA is also an expense.
Yep.
Utilities that are not paid by the tenant, so utilities that you pay, and then of course there's repairs and maintenance, and usually those are estimated. Hopefully you're conservative with those, but it's any of those types of fees that are going to take your gross income off of your gross monthly rents or income, and so you're going to subtract all of those fees from that. So that is what NOI is going to be.
Yep.
All right.
And typically, can I just toss this out there too? And we'll get over and maybe into a little multifamily, but typically your expense ratio, like if you're looking at the cap rate, your expenses are about 35 to 40%.
Almost always, man.
Almost always it comes out to be that. If you're getting numbers from somebody, let's say I'll just make this up. Sorry, I digress just for a second.
Sure.
Let's say there's a 20-unit apartment complex that you're looking at, and you're getting numbers, and your expenses are 28% from the numbers you're getting. Something's not right.
Yeah.
Something's not being included there. It almost promise you it's more like 35%. So
yeah, and that's on rental properties. We have a totally separate set of rules kind of for the creative finance stuff, because I'm sorry, let me rephrase that. We have a separate set of rules on the seller finance, because we have almost no expenses whatsoever when we sell or finance a property. So your NOI is going to look a little bit better on seller finance deals. Just a heads up.
Yep. Excellent. Okay, so that's just a quick review of cap rate. Net operating income, we just talked about NOI divided by your purchase price, quick and dirty. So again, just in the example I gave, we had a net operating income of $1,200 a month. It's $14,400 annually. Pay $240,000 for the property, so that is 6% cap rate.
Let me do this real quick. I'm going to share a screen here. I've got a NOI calculator up here. Can you see my screen?
Look at you getting all visual.
Okay, so hey, I'm a visual guy. So I based some of these are just assumptions here. These are actually kind of pretty normal prices in our neck of the woods. I mean, as far as purchase price, monthly rents that you get based upon that purchase price.
Can you make that a couple notches bigger just for? I mean, I can see it, but if it was a little bigger, it might be. There you go. Perfect.
All right. So this is just a real simple cap rate calculator. Very, very easy. So you have a purchase price of say 150,000, which is, you know, it's probably in our area. That's probably average, maybe just a touch high, depending. And I'm speaking purely out of rental. This is a rental property that we're looking at right
Yes.
here.
Yes.
All right, so we've got a purchase price of 150,000. We've got monthly rent at 1,800. That's probably average. Might be a little bit higher than that. Property taxes. Here comes our expenses. We're going to start deducting our expenses out of that, out of this annualized gross income right here. And so property taxes, $1,200 a year. If you have a property manager, I'd include it. I just made this zero. I think you should probably, these days, most people should probably self-manage. It just depends, I guess. Then you've got insurance premiums for the year. We've got leasing fees. That's if you're paying somebody, if you're paying, you say you rent a property out and you pay leasing fees to a property management company. HOA, talked about that. Utilities not paid by the tenant. And then, of course, the big one is repairs and maintenance. So now, if we go up here and look at our results, we have an estimated cap rate of 12.27%. All right, so we have to remember this. We're going to come back to this screen because we're going to compare rentals versus seller finance here. All right, so we're going to come back to this screen. For right now, I'm actually going to stop sharing this screen because now we're going to recap last week and talk about the loan constant. The loan constant is an extremely important figure. However, it's one of the easiest things to figure out that you can possibly. I mean, it's one of the simplest mathematical equations you can get. It's simple division. So what multiplication and division. So what we're going to do is for the loan constant, we're going to take our principal and interest only.
Yes.
Remember,
Not pity. Not
right.
pity. Principal and interest only.
Remember,
Yes.
taxes and insurance are applied to the cap rate. We're looking at only our principal and interest.
Yep.
We are going to annualize that. We're going to multiply that by 12. So our monthly payment times 12. And then we are going to divide that by the amount that by the loan amount. So whatever your loan amount happens to be, you're going to divide your annualized principal and interest payment divided by the loan amount. That's going to give you a certain percentage. Now, I don't have that. You're hard pressed to find a loan. This is why I don't think this is used very often by people. This is why people are running around trying to figure out comps and all this stuff. But it's I think it's essential, and I think it's a much faster way to figure this out. So we have our cap rate now. Our cap rate was
12.27.
12.27.
Okay.
Let's say that our loan constant. We can figure out what this is. Actually, let me pull this back up. We can figure this out.
Yeah,
really quick.
I can tell you. I was just actually doing that while you were
Okay.
on the. I might have been off too. So tell me. So we're doing 18.
150,000 is our loan.
Right. And so what is the so we just need to for our assumptions here, we just need to say our principal and interest payment is going to be how much?
Let me pull up handy dandy Carl's calculator, the greatest calculator on the planet. Change a couple figures here. 150,000. Let's say 150,000 at 6.25% interest for 30 years.
Okay.
Our principal and interest payment on that is $923.58.
$923.58. And I'm going to multiply that by 12 to annualize it. Yep. So that's $11,082.96. And then we're going to divide that by the amount of the loan, which we're just going to say is 150. Mm-hmm. All right. And that gives us a loan constant of 7.3.
Okay. So how do we know whether or not we have a good deal here? Here's what we're going to do. We're going to take this cap rate, 12.27%. We're simply going to subtract the cost of our money or our loan constant. The cost of our money is 7.3%. So what is that math, Ken? What do we come up with? 12.27 minus 7.3.
When I leave all my leading decimals in there too, we have a difference there of 4.88.
Okay. So that's the difference between our cap rate and our loan constant. That is our spread. That is what when people talk about, well, what's your spread look like? And they always give you a number. They always give you a dollar value, which I would argue is not the best indicator. It is an indicator. It's something that you should definitely have to consider. But the real indicator of the the actual spread that you have is the difference between this cap rate and that loan constant. That is the major difference. All right. So in this case, it's 4%. The general rule of thumb, and this depends upon, of course, personal taste. It depends largely on geography. You know, here we could probably achieve that pretty easily. In DC or in Northern Virginia, this is gonna be hard to it's gonna be hard to find a good um, it's going to be hard to find a good rate or a good spread. It's going to be much more difficult. But 4% is a very good spread. It's very good.
You,
General rule of thumb is
well, just actually, this is terrible. If the cap rate is greater than your loan constant, you have a bad deal.
no. Your cap rate your cap rate always has to be higher than your loan constant. If you pull up the calculator,
Oh yeah. No, sorry, I said that backwards, didn't I?
you've got it backwards. Yeah,
Oh yeah. Sorry, my fault. My
yeah.
fault.
No biggie. Um, but this is your spread. We have a 4% spread here, which is a very good spread.
Yep, almost 5 actually. Yep.
The general rule of thumb, uh, in fact, my own personal rule that I abide by when I figure out this calculation is I need at least a 1% spread, at least 1% or higher. I prefer it to be at 2, but I will, depending on what the rest of the numbers look like, a 1% spread is going to be you're going to be pretty safe. Um, so when somebody asks you, well, what is the spread in this deal, and they give you a uh, cash, a number, a monetary value, that can quickly become irrelevant depending upon what your expenses look like. But if I know the cost of the money that I've borrowed, and I know that cap rate, I know that that spread is not going to fluctuate very much at all. So 1% and above is probably a good baseline. It's going to be a good, you're going to make money on this deal.
Yep.
So I've still got this screen up.
It Yeah, and can I just say that in a different way too, since I
Mhm.
screwed up earlier. So the it's a way to determine that the cost if the cost of your money, what is the cost of your money, right? Can the deal cash flow to you with that cost of money? Does
Correct.
that make sense? And so in this particular case, we have a really big gap here. We have almost a 5 spread between the cap rate and the loan constant. So that's big cash flow to you, right? That's
That's
what
right.
that means. Yeah,
Yep.
so positive cap rate less their loan constant being greater than 1, as you mentioned, there is cash flow in your pocket.
That's right. If you ever have 1% or below, and God forbid you ever have a negative value, you run as
Run.
far away as you can. Yeah,
Yep.
it's not gonna you're gonna be it's not gonna work out for you, almost
Yeah.
guaranteed.
As our handy dandy note outline says, you bleed. You're bleeding money.
You bleed.
You're
That's right.
bleeding.
All right. So now that we have this established, should we recap this, or do you think we're good here?
Yeah, yeah. Since I screwed it up, probably just so. So you calculate your cap rate, right? Which we did, which is the calculator that you're showing there. It's a simple cap rate calculator. You calculate your loan constant, which is just your principal and interest, your annual principal and interest payment divided by how much the loan is, right? And then you compare those two numbers. So you take the cap rate and you subtract off the loan constant number. In our example here, it was like 4.88. It's a great cash flowing number. That tells you that this is a great cash flow deal for you. And
Yes.
as your rule of thumb says, you want it to be greater than one or more.
Yeah. Yep. Nailed it. All right. So let's move on. Let's get a little more let's get a little more detailed on the seller finance side. Now, if this is your well, first of all, let's look at the seller finance as far as a disposition goes. Let's take a look at this cap rate. Keep an eye on this cap rate right up here, and watch what happens uh, when I change some of these figures. Let's just keep our monthly payment at 1,800. That way, we're not manipulating this, like falsely manipulating this. Property taxes. When you sell on seller financing, how much does your company pay in property taxes?
Me? None. I
Zero.
pass it along.
Zero. It's passed along. You've sold the house. Your buyer pays the property taxes. So that's zero. How much do you pay in insurance?
Zero.
You pay zero. Are you watching this number up here?
Yep.
How much do you pay in HOA, utilities, or repairs?
Zero.
Zero. So now take a look at our cap rate based upon the same exact figures, only the disposition is now seller finance. What is the difference in this now, Ken? We had 14.4 minus 7.3.
You might 7.4. Yeah, it's a basically seven difference.
Okay, so we increased our cash flow based upon these exact same figures. I don't know what the actual number is in cash flow percentage wise. We jumped from 4.8, what'd you say, 7?
Yeah, it's right at seven.
Right at 7%. We have built in just by seller financing this property, we have built in another 3% spread on top of what we would expect from a rental, right? Okay,
Yep, because I don't have those expenses anymore. You're right. It's the end buyer that I'm putting in there. My
that's
end
right.
buyer is taking the burden of those.
That's right. Now we're going to get really creative. Now we're going to talk about buying a property subject to, and I do have to. We are going to have to kind of manipulate a couple, one particular field here, because let's say that, and this applies to, this is going to apply to your bottom line. Let's say, for example, totally hypothetical, that we have a property which the value of that property is $150,000, but we're going to buy this house subject to, and we're going to take over the loan. Let's now say that the purchase price that we're getting the property for, let's say it's 125,
Yeah.
because we're taking over a loan at 125,000.
Yep.
Now, the caveat here is that any expenses you have that, maybe you have to get in there and I don't know, maybe you have to put an air conditioner in it or something like that.
Yeah. Yeah.
Um, but we can actually manipulate that number a little bit later when we get down here to repairs and maintenance if we want to. But I'm going to say that we're taking over a loan at $125,000. But the value of that property is still 150, and that's probably what you're going to sell it for.
Yep.
But now we have a loan at $125,000. All the rest of the terms are the same. Let's say that hypothetically they're still the same. We got a 6.25% interest rate. It's a 30-year term. But Now our purchase price is only $125,000. Look at what that does to our cap rate.
Oh, more money in my pocket.
And guess what else? Your loan constant is going to change as well on this. You're going to affect your loan constant. I don't know what those. Maybe we can add that up here. Let me do. Let's do
It was
125,000.
sorry, I cleared my calculator. It wasn't like 928 a month or something like that.
It was, but if you calculate the, oh, it is. It was. It was 928. My bad.
Yeah,
Sorry. Sorry. Sorry.
at 125, which is our exposure, not the 150
Correct.
that was the original loan.
Correct. Yeah.
30,000's been paid down, or I'm sorry,
923.58. Yeah.
25,000's been paid down. Our exposure is just the remaining balance, which is 125.
Yep.
So now I'm going to take that, and that loan constant is 8.9. Oh, hold on a second.
No. It was 7.3, wasn't it?
It was, yes.
7.3. I wrote it down.
Times, yeah. Well, I think it was 978. I think my monthly number, like I said, I didn't keep it in my calculator, so
That was 923.58.
923.58. $923.58 times 12. And then divide it by 125.
Nope. It's divided by 150. Remember, that's our loan constant is our original. It was 7.3 is what I'm sorry. Yeah. Almost 7.4.
Yes, 7.4. Yeah, 7.39. 7.4.
Okay. So now let's do this math. Let's see what our actual spread is here now.
17.28.
Minus 7.3. We have nearly a 10% spread on this. That is asinine. That is insane. That is an insanely good spread.
Yeah, that says you got a great deal right there.
Absolutely. And
Great cash flowing deal. Cash flowing from the cost of the money, which is the subject to loan, right? That's your cost of money,
yep.
to what you're getting in income, right? Because you're seller financing it, what you're getting in income there. That's a lot of cash flow, brother.
It is. I'll tell you, the one I most recently had my buyer refinanced out of, as a rental, that thing would have cash flowed probably right around 500, 550. But because we took it subject to and we sold it on seller financing, that thing was cash flowing $900 a month.
Mm-hmm.
One single family property.
Yep.
So, go ahead.
Sorry, can we pause there for a second?
Mm-hmm.
You just say, well, that doesn't make any sense. Like if I'm just some guys listening to that, some real estate investors say, well, that doesn't make sense to me, Mr. Coffman. Like, okay, how's it? But remember, when we seller finance it, we don't have any of those expenses that you took to zero in the calculator.
No expenses.
That's the difference. That's what's creating that extra cash flow for you from 500 to 900 or 400 to 900.
Yeah, well, that and the fact that we've arbitraged that interest rate, which is another whole episode, that
Yep.
we're obviously charging a higher interest rate than what we, than what we were paying, or that we were paying on the loan we took over. So there's a number of factors, but that's just one example of what this type of knowledge can do for you. If you now, here's the drawback to this: if I sell or finance that property, I'm never going to be able to increase my spread ever. Never. It's just never. It's going to stay at 10%.
You're locking it in. That's right.
Yeah, which, depending upon your personality and what you and your tolerance level for tenants, toilets, and trash, it might be a good trade-off. But I can tell you that this is why this works. This is why, if you really dig into these numbers and you really get creative with figuring these things out, and once you nail this, this is the holy grail, if you ask me. I have got a 10% spread. I've got no more exposure to the property at all in terms of maintenance or repairs or dealing with HOA. And I have none of that. So I mean,
Yep.
here I am advocating for seller finance. It's not that wasn't the mission behind this podcast at all. But I just wanted to give you some examples and mainly just show people why, number one, why cap rate is so important to calculate on single family homes and what it actually means and how to use it to your benefit. I mean, it's one thing to just know what the cap rate is on a property. That's fine. You can compare that to other single family properties in the area or deals, but how do you actually use it?
Yep.
And how you actually effectively use it is in this equation. Cap rate minus loan constant equals spread percentage. It's
Yep.
that simple.
And you want it to be greater than at least one or
Right.
more, and that means it cash flows to you. And in our example here too, that's an insanely good, 7 point, 10 point spreads. Like that's an insanely good deal. Like you probably won't see that. We were just doing it for example purposes, but just so you
I've
know,
seen them. I've seen them for sure.
they're out
Yeah.
there.
Oh,
They're
yeah.
out there for sure, but that's not the norm. When you see it. So just to summarize, to close it out, cap rate is a measure of how good the property is, even if it's single family, right? So how good the property is. The loan constant's how good the loan and the financing is,
Yep.
and the comparison of those two numbers tells you whether you cash flow or bleed.
That's right. Yep. Yeah. And then of course, you dig in deeper and if you depending upon your exit, obviously almost always you're going to have, if you go the rental route, you're going to have expenses. So that's going to dig into that. It has a potential of digging into that spread a little bit. Um, but with the seller financing model, if we turn around and sell these properties to a buyer, um, yes, those figures are locked in for the life of that loan, but have way more levers to pull as far as getting that spread up as high as you possibly can.
Yeah, well, you're locking it in because you're offering the financing, so you're locking in all those numbers because the financing you're offering to the end buyer, but you're also don't have to screw with anything anymore moving forward. Like there's an upside there too. It's like, okay, well, I can't increase rent, I can't increase the loan amount because I've locked it in, but I don't have to screw with anything. I don't have the tenants, I don't have the toilets, I don't, and all that too. So it's a trade off. And
Yep.
who doesn't want, in our example, $900 a month, or what, $900 a month cash flow? Like,
Yep. Yep. Yeah. So I really hope that I was clear in that.
yes, so that was great. I'm the one who screwed it up that one time, so hopefully we got that squared away.
It happens.
Cap
It
rate
happens.
minus loan constant, you want it to be a positive number, and you want it to be greater than one,
Yes.
right? So that's what
Yep.
means in cash flow. So that's it. And by the way, just so we didn't bring up the subject to profitability calculator. Good God, it's got this built into there. It's got
Yep.
the cap rate. When you put all your subject to parameters in there, just like we were talking about, it's got this calculation built in there on the disposition page, right? So if you don't have, it's free. If you don't have a calculator, I don't know what the hell you're doing. Go get our calculator, and once you get it, you'll get the how-to video that goes along with it, and that's what we use, right? So, and
Here.
then actually just cut the middleman out, Mr. Coffman. Just come into our partner program, and we'll just take it from the top, and we'll
Well,
show you how to use the calculator. Yeah.
let me do this. Let me go ahead and if you can take that down off the screen. Let me
That,
go ahead and pull this. I brought up a copy of the calculator. Simple spreadsheet, but highly effective.
yeah.
Where we're going to find out our cap rate and our loan constant in the calculator is going to be down here on these little tabs. Can you see that down there? Is it too small?
It's a little small, but it's the owner finance disposition tab that has it in there.
Yes. So this is the owner finance exit tab. If I click on that, you've got all of the, of course, this isn't completed, but you've got this little section down here that does this calculation for you.
Yep.
And you see we got cap rate here, loan constant, and the spread. And then we have an option. Um, this little box right here that I'm highlighting, that one, you can manipulate that box. And if your loan constant is, I'm sorry, if your spread is below 1%, you can actually manipulate that so that that jumps up to where you need it be. And then this becomes your offer price, your new offer price on the house, on the property.
Yep.
All right. We've got the same thing for lease option. Some people choose to go down that road. We have that same calculation down here. And then we also have it for the rental properties. So really, really valuable information to know. And I think that, again, this is going to be like the trust thing. I'm trying, I try like hell.
Yes.
I just want people to really understand the power of trust. I also want them to understand the power of this very simple mathematical calculation that can give you an answer as to whether or not the deal you're about to get into is actually going to be a good deal for you. It's the simplest way to figure this out. It's the very first thing you should probably do. Instead of running around and doing all these comps and then having these assumptions about your expenses and all this stuff, just do this first. See if you've got a good deal first. That's all I'm saying.
It's yeah. And so I was just talking shit about, hey, if you don't have our calculator, why don't you have our calculator? And I'll be damned if I didn't see a pop up saying somebody just downloaded the calculator. it was like almost amazing in real time. So it's that's good stuff. Yeah, and we just sometimes I think, I mean, it was kind of a detail oriented last couple of podcasts, but sometimes I think because we look at that so often and we just use the calculator, especially on the subject studios, we just use the calculator like it. I mean, if we're not, I mean, so it's just right there. It's just like,
it's just kind of
it's second nature. So we don't, but I think it was good to learn. And you're right. It's so simple. The math here is so simple to figure out whether you have a good deal or not.
Yeah.
The devil is in the details. The cash flow is in the details, brother.
And how many people do you know that get into some of these rental properties on these super thin margins?
Yep.
And if they just would have figured out this calculation, they would know that literally right off the bat. It might take them a minute to figure out this calculation. Or if you've got the sub 2 calculator, particularly if you're taking a subject 2 deal, you want to figure out what that figure looks like. If you want to figure out what the best disposition strategy is for that deal, then that sub 2 calculator will spit that right out, and you'll know which exit strategy to use.
Yep. And can I just go before we sign off here for the day? I just want to say too that I do love me some land trusts. I just helped someone out with a land trust on the thing, and then he was like, "Well, I think I wanted to sell finance," and I was like, "Just seller finance inside the trust, man. Just do an agreement inside the trust." He goes, "What?" I said, "Yeah." I should have charged him double just for that pro tip, and so somebody did it. Did the note and everything inside the trust, and is cash flowing the deal in his pocket. You know what I mean? So it's like,
100%. That's
Mr. Coffman. We need to charge more.
That's a thing that particular instance that a lot of people, trust in themselves can be. It's hard for people to wrap their minds around how it actually works. But once you understand, I think, and I call it a position, if you understand what beneficial ownership is, that is considered personal property. And can you sell personal property?
Yep.
Of course you can. Can you finance personal property? Well, of course you can.
Yes.
So, anyway.
Right.
Yeah. Yep. All right, man. Well, I hope that came through clear. Sometimes my brain gets jumbled around up there trying to explain things. Sometimes I lose the order in which I'm supposed to explain them. So I really hope that came out.
No, you were great.
It's helpful and understandable. So
yeah. And I'm usually the obsessive compulsive one with the numbers and the data, but you're perfect.
Well, see, I put the hard work in up front trying to figure this out and learning this stuff. And so now it's kind of like the phone. It's kind of dumbed me down. It's like, okay, I just go fill out that calculator. What does that say? Is this a good deal? Yes or no? Boom, I'm done. That's it. Simple. All right. Anything else you want to close out with?
No, I just think have a great Thanksgiving. No podcast next week. Have a great Thanksgiving and keep your eyes out. We need to, there might be some kind of holiday promotion coming up. So keep your eyes out on our channels and social media and all that good stuff.
Right on. All right, guys, I'm calling it. You guys have a good one. Happy Thanksgiving. We will catch you not next